Hello and welcome to Chapter 18, Forward Exchange and International Financial Investment. In this chapter we're going to look at covered and uncovered interest rate parity, and what this does is link the return on assets in two different countries with the forward and spot rates for the exchange rate in those two countries. So first of all, we've got to define what exchange rate risk is. If you're exposed to exchange rate risk, then the value of your income or wealth will change when exchange rates change. One way to deal with that is to hedge. That is to take an action that reduces that exchange rate risk. So for instance, if you're holding a lot of euros and you're worried about the value of the euro going down, then you might want to buy insurance on that so that you don't lose out. In other words, you might want to hedge that risk. And when I say insurance, I don't mean going to an insurance agency. I mean there are instruments in the market which allow you to basically insure that position. In other words, if the euro does go down, then there's something else that you own that goes up in value by the same amount. Speculation, on the other hand, is taking an action that increases your exposure to exchange rate risk. So there are people in the markets who think that the exchange rate is going to move in a certain direction, and they will take a bet on that happening. So in the forward market, deals are transacted, as we've said in the last video, usually for 30, 60, 90 days, etc. And banks provide those forward exchange rates on all major currency pairs. And it's convenient for customers and corporations that are viewed by banks as acceptable credit risks. So don't confuse the forward exchange rate with the future spot exchange rate. The future spot exchange rate is the spot exchange rate that exists at a date in the future, whereas the forward rate is doing a transaction for foreign currency now in terms of setting the price, but not actually doing the trade in terms of the actual exchange until a certain number of months hence. So hedging in reality means reducing both kinds of open positions in a foreign currency, both long positions and short positions. Long positions, you probably know this anyway, is holding net assets in the foreign exchange or in the foreign currency, and short positions is where you own more of the foreign currency than one holds right now. A forward exchange contract is a direct way to hedge that risk. Speculators are people who want to take a net position in the foreign currency. We've already said that. One way to speculate on the value of a future spot exchange rate is a forward foreign exchange contract as well. But there are more profitable ways to do that if you want to take a bet on a foreign currency. And these usually involve things like currency futures. They're contracts that are traded on organized exchanges such as the Chicago Mercantile Exchange, the CME, and the currency future basically locks in a price at which you buy or sell a foreign currency at a set date in the future. It's a bet, though, on the currency going in a certain direction. So you don't actually do the trade, set the price now in terms of having to do the trade in the future. You're just doing a bet on the currency moving in a certain direction. Futures, options, and swaps are what we call derivatives. So in other words, they are not actual exchanges, not actual price to exchange the currency into the future, but just a bet on the currency moving in a certain direction. The currency option gives the buyer or holder of the option the right, but not the obligation to buy foreign currency, which is a call option, or to sell the foreign currency, which is a put option, at some point in the future. So it's a right, but not an obligation. So this is more like an insurance policy. In other words, if it goes in the direction you want it to go in, you gain. If it goes against you, you just have spent the money to get the policy, but you don't lose anything. In a currency swap, two parties agree to exchange flows of different currencies during a specified period of time. So swaps are a bit different from those other derivatives there. Decisions about international investments are based on the returns and risk of the available investment alternatives. So here we're now setting up for the uncovered interest parity, or the covered interest parity. So we're going to do covered actually first. So this is looking at a firm or a very rich individual who has the option to either put their money into a US bank or to convert the money into foreign currency, hold that in a foreign bank, and then convert it back into US dollars at a later date. In other words, these are two different strategies. Domestic versus converted into the foreign currency, earn the foreign interest rate, and then convert it at a future date back into the domestic currency. Now, if you are organized about these things, you can probably, if you do the second of those strategies, going into the foreign currency, you can fix the price at which you will convert back from the foreign currency into the domestic currency for the future date that you will want to do that transaction. If that's the case, it's covered. In other words, it's hedged. If you are just going to take potluck and say, well, I'll just do what the spot is at that point, 3 months, 6 months, 9 months, a year into the future, then that's called uncovered. So in other words, there's a speculative element there. So let's concentrate first on international investment with cover. So the investor starts with domestic currency. Of course, they can either leave it in domestic currency, and that's what we're going to compare it to. It's going to be our baseline, if you like. But let's look at the more complex option here. The investor then buys the foreign currency using the spot rate exchange rate E, invests in that foreign currency denominated bond or high interest earning account, so earns that I subscript F, and then sells the foreign currency forward, knowing already how much they're going to get because interest rates are usually quoted anyway into the future. So the current forward rate F. So you can do the whole deal in one fell swoop. So at the maturity of the investment the investor is going to have 1 plus IF, that's how much they earn abroad, times F, the forward rate of bringing that currency back from the foreign currency back into US dollars, divided by the current exchange rate of converting it into the foreign currency from US dollars. So overall, the covered return is approximately equal to F plus IF, where F is the forward premium on the foreign currency. So we've got to define what the forward premium is here, that cap F. It's the proportionate difference between the current forward exchange rate and its current spot rate. So it's F minus E divided by E. So in other words, if we're talking about dollars per foreign currency, if the dollars per foreign currency is higher into the future, so the market thinks it's the foreign currency is going to appreciate, then F will be greater than E, and therefore cap F will be positive. So in other words, here you're looking at the currency, foreign currency appreciating, then F is positive. Now that means that the dollar depreciates if F is positive, cap F is positive. So if we're looking at the other way, that the currency concern depreciates, so little f is less than E, then it's obviously going to be negative. So the currency is a forward discount because it loses value between buying it at the current spot and selling it at the current forward rate. So the foreign currency depreciates. That means the domestic currency, in other words, the dollar, must be appreciating. So if F is negative, we've got dollar appreciation. If F is positive, cap F is positive, we've got dollar depreciation. So the covered interest differential is the difference between the overall covered interest international investment return and the domestic return. So what's the domestic return? Well, it's 1 plus I subscript D. That's just the interest that you're going to get per dollar if you leave it in the domestic currency, dollars in this case. Now, if you convert it into the foreign currency and you do this round trip, in other words, you convert into the foreign currency, you earn the interest, and then you convert back at the forward rate, then we've just said that the return is 1 plus I subscript F times the forward premium there, F over E. Or approximately, we can write it as F, cap F, plus IF minus ID. So notice what's happening here. The covered interest rate differential is going to be 0 if the change in the exchange rate plus the foreign interest rate minus the domestic interest rate is 0. Another way of looking at that is to say the forward premium, if you like, should equal the interest rate differential between the foreign interest rate and the domestic rate. So this is covered interest arbitrage. It's making a profit when CD is non-zero. In other words, buying a country's currency spot and selling that current country's currency forward to make a net profit from the combination of the difference in interest rates between countries and the forward premium on that country's currency. It's riskless, but it does tie up some assets for a while. Now, what we're going to see is that the actual opportunity to make profits here would be arbitrage profits then. So they'd be self-eliminating because rates would adjust so that the covered interest differential would be driven to 0. In other words, covered interest parity, CD, should be equal to 0. The overall covered return on a foreign currency investment equals the return on a comparable domestic currency investment. Currency is a forward premium by as much as its interest rate is lower than the interest rate in the foreign than in the other country, and the currency is a forward discount by as much as the interest rate is higher than the interest rate in the other country. In other words, if you have a higher interest rate in another country, it kind of signifies that that country has to attract money into the country because it thinks, or because investors think that its exchange rate is going to depreciate. So, and the opposite way around. So, if covered interest parity holds, it links together 4 rates: the current spot rate, the current forward rate, the current interest rates in the 2 countries. If one of these 4 things changes, then at least one of the other rates must change to maintain that covered interest parity. But we've said that needs to hold due to arbitrage. So with international investment without cover, the investor is exposed to exchange rate risk because the actual return depends on the actual value of the future spot exchange rate. So here we now move into uncovered interest parity, which is uncertain at the time the investment is made. So at the time the investment is made, the investor can use, instead of the forward rate, the expected future spot rate, which we're going to write as little e to the super EX, to calculate the expected return to the uncovered foreign financial investment. We can write that just in the same way, except by replacing the F, little f, the forward rate. And so that's written there, or approximately the expected rate of appreciation or depreciation if negative of the foreign currency plus IF minus ID. So risk considerations can be small if investors do not care much about risk exposures. In other words, they're risk neutral. And the benefits of diversification indicate that additional uncovered investments add little to the overall riskiness of the investor's portfolio. So this uncovered interest parity is an interesting idea. Some people call this, by the way, the international Fisher effect. The expected uncovered differential equals 0. So that's what we would expect. But of course, there might be some times when that is not the case. In other words, expectations in the market differ somewhat. And obviously, you can think of that as a distribution. Some people may have better information than others, etc. Or there may be certain events that cause the uncovered interest parity to have a lot of uncertainty connected with it. So the currency is expected to appreciate by as much as its interest rate is lower than the interest rate in the other country, or it's expected to depreciate by as much as the interest rate is higher than the interest rate in the other country. So if uncovered interest rate parity holds, it links together once again these 4 rates. If one of these 4 rates changes, then at least one of the other rates must change to maintain uncovered interest parity. So does covered interest rate parity really hold? The empirical evidence is that it pretty much holds, except with countries that have what they call capital controls, where money cannot flow freely between the countries. And that's, if we have capital controls, that stops the arbitrage taking place. And also, we can, of course, have covered interest rate parity not holding if there's a lot of new information comes into play between when the spot rate is and the forward rate is. So if you have a lot of financial market turmoil or crisis, then it could not hold. It might not hold. Pretty much the same thing with uncovered interest parity. It's more difficult because we've got to get hold of the expectations of exchange rate market participants, so foreign exchange market participants, and you have to do a survey in order to assess this. So it's a lot more difficult, and there's a kind of a distribution there rather than an actual rate in the market as per the forward rate. And you can examine actual returns if you want to do it ex post, so how things turned out on uncovered international investments to draw out the inferences from that. Uncovered interest rate parity is deemed by most economists to hold, but it's a lot more approximate, so there appears to be substantial deviations there. Thank you very much for listening, and I believe that is the end of the PowerPoint.